You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Welcome to Retirement Friday. Today, we're going to talk about some pre-retirement investing strategy. A lot of things to talk about, so I think it's going to be kind of like an ongoing series for a few Fridays to talk about how you can position your portfolio as you move into the transition of retirement. And the reason why I want to talk about this is there are like so many rule of thumbs and kind of like bad informations or simply terrible advice that are going out there. And all of those advice they're coming from the fear of losing money. And when you fear of losing money, well, of course, you're making a lot of irrational decisions, such as going for the magical rule of thumb of I'm going to take 100 minus my age, and that's going to be the percentage of my portfolio invested in equities. So if you retire at 65, well, 100 minus 65, that means that you're already only 35% in stocks. So what's the problem with this? Well, the problem is maybe you have a higher risk tolerance than this. Maybe you can definitely stomach a 15 or 20% portfolio value drop without blinking. Well, if it's your case, having only 35% of your portfolio into stocks is probably going to limit your expected returns and for nothing, because you could have like taking additional fluctuation in your portfolio without blinking. So of course, it really depends on a case by case, but that's why the rule of thumb is not that great. It's also coming from the fact that, I'm going to retire next year. So now it's time to transform my entire portfolios, like all the portfolios that I have, into something super safe. Well, you're not going to deplete your entire nest egg on year one of your retirement. Actually, quite the opposite. You're going to withdraw from that portfolio probably for like 30 years, maybe more. So you're going to keep investing for a very long while. And if you have done like a very good plan, which you should do, like no matter how much you invest and how much you're worth, you should have a plan. But if you look at your plan, chances are some specific account, like targeted to your situation, some accounts will not be depleted. You might not even withdraw from some accounts. Like very, very often, what I see is the TFSA, the tax-free savings account, is not going to be touched at all if you have like a pretty solid plan, or it's going to be the last one. So why would you put like 60, 70% of your portfolio of your TFSA in fixed income if you're only going to maybe start taking money from it in 20 years from now? Like what's the point here, right? Again, making irrational decisions based on fear. Because if you're not about to touch your TFSA for the next 20 years, you should probably just follow the same strategy as you are right now. And because that works, because you're confident in that strategy and it's all great. And it's going to probably offer you a higher expected of returns because you do not have to plan withdrawals from this one. So now going back to the basic and the obvious, all those rule of thumbs and thinking about protecting your portfolio all comes from something that actually makes sense. You do not want to get stuck selling equities when the market is down. If 2025 is a terrible year in the market and you're down 20% in your portfolio, you certainly don't want to sell some shares to finance your retirement. Totally makes sense. So you want to protect your portfolio and your plan against the sequence of withdrawals. So like the fact that you're forced at one point to withdraw money while the market goes down. So you want to protect your portfolio from a downturn. So first, the very first thing that you must do is to identify where the money is going to come from. Is it going to come from your RSP that you're going to deplete faster than waiting until it turns out into a RIF at 71? Is it going to come from non-registered assets because you have like a large portfolio that is taxable. So maybe it's better this way. Is it going to come from dividends? Maybe you generate enough dividend to live off your dividend paycheck, which would be amazing. But again, I want to highlight that if you focus on dividend too much and just go for the higher yield, like it's probably a mistake, because those companies, they pay a high yield for a reason. Most of the time it's because those are struggling companies. So if you want to fill up your portfolio with struggling companies, not too sure it's a good idea. But I mean, you do you. I'm not here to tell you what to do. But again, that's the whole point. It's to first identify where the money is going to come from. If it's going to come from your non-registered portfolio, this is the one that you need to prepare for retirement first. So if in your plan you're not going to touch your RSP in the next 10 years and then the TFSA in the next 20 years, well, those two accounts can wait. They can be invested just as usual, because even if there's a downturn, you're not going to touch those accounts. So it's not going to matter. You can let them take a hit, recover, and then keep on moving with the strategy that you are comfortable with. Super important here. It's not the best strategy to generate the highest return that is important as you move into retirement, but it's the best strategy that gives you the highest level of conviction. If you sleep well at night with your strategy and you generate enough returns to meet up your objectives, your plan, because of course, if you put everything into money market funds, you're not going to have to worry about market fluctuation, but maybe you're going to worry about outliving your portfolio, right? Because maybe the interest rate on the money market fund will not be enough after taxes, after inflation, to cover your retirement fund for the next 35 years. So that's kind of like another type of problem. So you have to consider this. But as long as you understand what you're doing and you're comfortable with, this is the best strategy. So the tip today is to not go across all your accounts and change everything a year before, 2 years before, or the day that you retire, but rather identify where the money is going to come from. And if you don't know, well, it's super important that you start doing some research to do your financial projections. And after that, well, you can decide which portion is going to go into cash, into GIC, into bonds, or into gold. We actually had an amazing webinars yesterday at Retirement Loop, my retirement community. So I had like 2 loopers, like that's how we call our Retirement Loop members. So 2 members coming up on stage with me talking about gold and how to invest in physical gold and ETF, and in looking how to invest into companies that are like major or minor, like junior companies into gold. So super interesting webinar with information coming from the community. And if you are curious about this kind of like webinar that we do and want to know more about Retirement Loop, you can go at moosemarkets.com/retirement to sign up for the waitlist. Right now, Retirement Loop is closed. It's going to open later on in this year, but just to show you what we do. So like we had a lot of questions about gold. Well, you know what? We created like a kind of like a small panel. We spent an hour answering all questions. Even I, which I don't invest in gold, I learned a lot. So that was like super interesting. The replay is available on the membership website, like kind of like forever. I'm going to like even build kind of like a quick summary as well for those who do not want to watch the entire video. But yeah, so like moosemarkets.com/retirement, definitely the best place for you to get the information, start working on your retirement plan. If you're about to retire, it's definitely the right place to be. 100% free. I'm going to send you a lot of free information. And then whenever we reopen Retirement Loop, you're going to be the first one to know. So keep in mind, once again, do not follow like general rule of thumbs when it comes down to preparing your portfolio for retirement. A very good advice for you could be a terrible one for your neighbors. So if you're listening to your neighbors, maybe that will be a terrible advice for you as well. It's a case by case. It's all different depending on how you built your net worth, how you're going to generate income from those sources, and how long you're going to live, what you want to do. So super important. identify the account that you need to prepare for retirement. And then we're going to work on this one in the following podcast of the Retirement Fridays on Moose on the Loose. So do not forget to subscribe to the show. And if you had 5 seconds, give me a 5-star rating on Spotify or Apple Podcasts. That's my pay on this one. So I'm not asking you anything else, but just to give me a 5-star rating if you have enjoyed the show. So right, Moose, that's enough for today. Next week, we have a series on my investment rules. So from Monday to Thursday, we're going to talk about all my investing rules. And then on the next Friday, we're going to attack how to build that cash reserve to protect from market downturns. So, all right, take good care. Have a great weekend. And we're going to talk again on Monday. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.